Hey guys, Ron here on our next video here on the play-by-play beginners course. What we're going to be covering here is what are the differences between at the money, in the money, and out of the money options. Okay, so let's go ahead and get straight to it, and let's go ahead and cover it. Okay, so again, the acronym is ATM for at the money, ITM for in the money, and OTM for out of the money. Just need to understand that you have the option to buy at the money, in the money, or out of the money, and vice versa. You can also sell at, in, or out of the money. Okay, so what are the differences and what does this look like? Okay. On the Thinkorswim platform, your options chain is going to highlight the positions or the strike prices, again, the strike prices that are in the money, and then it'll leave the other ones that are not in the money as non-highlighted. So as you can see here, the call options that are in the money from 1912.5 and lower, these are highlighted in this bluish highlight, bluish purple highlight. And for the put options, same goes for the 1915s and higher. Okay, so these are in the money for the puts. These are in the money for the calls. Okay, and then we have our out of the monies are the ones that are not highlighted. So it's very simple. So these are out of the money, and these are out of the money. And what does this mean? That and then finally the 8 at the money is basically the ones that are basically right at where the stock is trading at now. So basically 1912, like right in between here is 1913. 1913 is basically where the stock is trading. That's basically at the money. So when these are at, let's say specifically at 1915, let's say the stock is exactly 1915, you're at that borderline. That's what at the money means. So usually you go with the ones that are pretty much right here. So these are at the money. Okay, so what does this mean to be in the money? To be in the money means that you are a penny or higher when it comes to put options, that the value of the stock, when it comes to Amazon in this case, so if you're looking at 1915, Amazon finishes at 1915 and a penny, right? That means that Amazon is in the money. So the 1915 puts, oh actually I'm sorry, for the put side, 1915 and a penny or and a penny below. So if Amazon finishes at 1914.99, that puts the 1915 puts in the money at expiration. So that means that at expiration they will be worth something and they won't be worth anything. So anything that finishes out of the money at expiration is going to be worth $0. Okay, it will be worth zero. Nothing, no value assigned to it once it expires, just out of the money. Anything that expires in the money will have some kind of value assigned to it, which is called intrinsic value, and we'll cover that in videos to come. But basically, it'll have value because it finished in the money. And then vice versa, on the call side, anything that finishes in 1915, for example, on the call side, it'll be in the money so long as it's below the stock price is higher than the strike price. So again, if you're looking at the 1915, Amazon needs to finish at 1915 and a penny or higher to basically be in the money for these strikes. Okay, so if Amazon finishes at 1915, then the call option will be considered to be in the money at expiration, and it will have some value. So you want it to finish typically. Depending on your directional bias, or if you're trading spreads, or you're trading just straight to single puts or options, that's where it makes a difference, whether you want these to finish in the money or whether you want them to finish out of the money. So there's different ways to trade options, and we're going to cover all of those ways on videos to come. But just understand that the in the money positions are the ones on the Thinkorswim platform that are highlighted, and the out of the money ones are the ones that are not highlighted. Looking at another platform, you have the Tastyworks platform here. You'll see that there is one line. Okay, you have this one line here that basically tells you what's in the money for one side. Okay, so you'll see here that the in the monies for the puts are from this line and downward. So 1915 or higher on the strike of the price of the instrument, and then 1912.5 and lower for the call side are the ones that are in the money. So as you can see here, these are not highlighted, but you need to understand that the in the money ones for the call side are the ones that are below the current strike price or the current price of the instrument, and the ones that are in the money for the puts are the ones that are above the current strike price or the current value of the underlying. Okay, so puts are the ones that are in the money are the ones that are above the current price, and the ones that are in the money for the calls are the ones that are below the current price. Hope that makes sense. And I hope you guys learned something. It's pretty simple. So you have out of the money, in the money, and at the money, which is basically the actual value. So the at the money price is around 1913. There is no strike at 1913 obviously here, but that the at the money price is basically just that, where the stock is trading now. We'll cover these and how to use these to your advantage on the videos to come. But that's pretty much it for in the money, out of the money, and at the money strike options. I hope you guys learned something. I will see you in the next.